This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
5 out of 5 for the Jason Hartman podcast. Thanks to his teachings, I have no worries about my future. My future is bright, and that for my family. I recommend the Jason Hartman team to anybody who is interested in financial freedom by way of real estate investing. 5 out of 5.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome, empowered investors. This is episode 2216, and today we have more Doomer's Delight as we have Harry Dent with us again. And you know, one of the interesting things, among many, about the philosophy of the Doomers and the people who think that things have to somehow revert to where they were, is if you're studying a chart, if you're studying trend lines, and say, for example, you look at housing affordability, well, why would housing have to become more affordable if the supply and demand dynamics changed? That just makes no sense at all. What if you add 11 million illegal immigrants to the population? What if the population grows by another 10 or so million people organically or internally? What if the housing supply doesn't keep up with that growth? Well, obviously, the chart becomes pretty meaningless unless you use a whole bunch of charts and put them all into the mix. So anyway, we have a long discussion today. I must warn you, if you are depressed, maybe you shouldn't listen to this episode. But if you like doom and gloom, here you go.
Okay, so back to the real estate thing, though. Look, housing affordability is the worst it's been in about 4 decades.
Yes.
It's terrible. Everyone would agree. But here's the reason that all the doomers got it wrong and I got it right. I think this is the fundamental reason. There's about 140 million housing units in the United States. When interest rates went up and prices were already elevated, housing became very unaffordable.
Yeah.
And the people that got it wrong viewed it this way. They viewed it as though, okay, a new entrant coming into the market to try and buy a house, it's very unaffordable for them. So that's naturally going to mean that demand will decline and prices will decline as demand goes down. But here's why they got it wrong. Because they didn't look at the tens of millions of people, about 130 million since rates went up, who control the existing inventory that don't want to sell because of their very, very cheap mortgages.
Right.
That have become an asset.
They cannot afford to get out of that mortgage. Yes.
Right. So because they control the inventory, it doesn't matter, even as demand has declined a bit, there's been demand destruction, prices have still gone up. I mean, you know, supply side economics, right? It's the suppliers that mattered. There are tens and tens of millions of people that have very comfortable mortgages that ain't giving them up.
Jason, I'm going to stop you right there. Yeah. Okay. How do elections work? You know what decides elections? A tiny percentage of it, the swing vote.
Okay.
10, 20% at most. It's the same in economics too. Everybody can be doing everything normal and they're not going to change. It only takes 5% of people to just become all of a sudden net sellers or to get price out of the market. And then that starts it. And then the more prices go down, the more they go down. So that's the thing people don't miss. Yes, most people are not going to cause or trigger this crash. It doesn't take a lot of people, but people have to eventually sell these houses, whether they die or trade up to another one. And at some point, price alone will erase a bubble. And there's no bubble ever in history that has gone up forever and not crash. And no bubble that's gone up a lot hasn't crashed a lot. That's all I know. This may be the first one, Jason, and you and many people I talk to have theories of why this one will be permanent plateau. I'm telling you, I wouldn't bet 1 penny on a dollar on that scenario. Not even 1 cent for 10x returns.
I think it's pretty protected until one of two things happen.
Yeah, until something goes wrong. Exactly.
Well, hang on. No, not something go wrong. This is something goes right, actually. Until number one, we can create a lot more supply, or number two, we can create a lot less demand. Until those things happen, and real estate's very sticky. It's hard to create new supply of built real estate, right? Well, the one thing I always say, Harry, is that the one thing you must have, the one ingredient you got to have a real estate crash, is you have to have tens of millions of distressed homeowners that become millions of distressed home sellers. And right now we have the opposite of that. We have all these comfortable people that aren't in distress, right?
Let me tell you something else that can cause a crash.
Yeah.
A crash happens somewhere else. Can you think of some tiny little country over in Asia that has a real estate bubble that's already starting to fall?
China.
I've been preaching this forever. Yeah. That bubble makes ours look like peanuts.
Well, you're talking about Japan or China?
China. Well, okay, Japan's already. Japan's
gone through it for 3 decades.
When the rest of the world didn't, just because they got overvalued and their demographics slowed. There was none of this stuff you're talking about here.
Yeah. So that's
real estate got extremely overvalued.
To your point,
and then their demographics.
Harry. To your point, you made me realize more than any other economist, because you study demographics. A major part of Japan's lost couple of decades was their demographic decline. They had a demographic problem.
Almost all that. But it also is preceded by a bubble. A bubble bursting makes any downturn.
But the U.S. has demographic growth.
Let me just get something straight here. 100%. When you see depressions in history, they follow major bubbles. When you see deep recessions, that just follows a boom. Recessions follow ordinary overexpansion of businesses and consumers and booms. It is depressions that follow bubbles because of the financial asset contraction that just makes it way worse.
Okay, so we'll agree to disagree.
And this is the biggest bubble in history, and it's the most global. End of story. Can anybody tell you, if you talk to anybody to tell you how much financial assets there are in the world now and how much there should be?
Yeah. Well, it depends how you count the derivatives, right?
630 trillion, it's 6 times GDP, and normal would be 2 times GDP at 200 trillion. In other words, we have about 400 trillion overvaluation in financial assets, which cost everybody money. Now, if you can keep borrowing against that and they keep going up, yes, you can keep this thing going a long time. But at some point, you can't have a house cost so much that even a strong upper middle class person cannot afford it.
You know what I think happens, Harry? It's like this, and we'll talk about this chart that's on the screen in a moment. But I think what happens is this. And this is what economists don't see, is people capitulate. They learn to accept less. This is what inflation does. It's insidious. It destroys people's standard of living. And so
people will buy a smaller house. That's one thing.
Yeah, absolutely. So it would be like this. Hang on. Let me finish my example. It would be like this. And you alluded to it because you talked about Puerto Rico versus Miami, right? And how overpriced Miami is. So it would be like this. It would be like someone moving from Memphis, Tennessee, or Nashville even, which is nicer than Memphis, to New York City, right? So they could have a big giant house in Memphis, and they move to New York City and they're living in a 1-bedroom condo.
Small condo.
In other words, they just learn to accept less as the standard of living goes down due to inflation. It's the same person, they're just accepting less. The standard of living has declined. That's what happens.
But the areas with lower cost real estate, like in the Southwest and Southeast, grow much faster. People don't just stay that way. Some people accept it, but more and more people don't accept it. And that's
I agree. And that's why we like those linear
out
markets.
Of California in the Northeast into the rest of the country.
Oh, I agree. Listen, that's why we invest in those markets, those nice linear cheap markets. Yeah, we like them. I agree. Hey,
and I'm in Puerto Rico. My house would be 3x in Miami here.
Yeah.
3x. Well, probably 4, but 3x minimum. Now,
and with the ability to do remote work, I mean, it's so easy to just live where you want.
Yeah, you know? Well, and 20 years ago, I didn't move here because San Juan wasn't a first world city yet. San Juan is a good city now. It's a first world city. I mean, it's not New York or San Francisco, but neither are a lot of cities in the U.S.
Hey, listen, New York and San Francisco aren't New York and San Francisco anymore either. Okay, they've become shitholes.
I couldn't even visit San Francisco now; it's so bad down.
It's a disaster. It's terrible. Okay, look, you asked me to share this chart, and this chart for those on audio only, I just want to make sure you know what we're looking at. The chart is entitled "Bitcoin Declining Megaphone Should Reverse Sharply Down by 68,000." What is this chart telling us, Harry?
Okay, so Bitcoin, I focus on Bitcoin for one reason, that the whole, crypto sector, not just Bitcoin, it's set to restructure all the financial assets on a global basis, and Bitcoin will end up being the digital gold, but that's decades from now. But this is...
So you like Bitcoin? Are you pro or against?
It's a leader in the next... Most of these crypto coins will fail. It's not that, but crypto itself is one of the next big things, particularly in financial services. So this is real, and Bitcoin is in its baby bubble. I actually compare, Jason, Bitcoin to the leader in the .com bubble just 22 years before it, Amazon, and they're almost identical. Amazon went from $6 to 136 in the baby bubble, just like Bitcoin just went from nothing to 73,000, and then it crashed all the way back to $6, okay, in the 2002 tech bubble crash. So that first bubble was the first tech bubble. We just saw the second tech bubble, and this is part of a 45-year cycle I track, every 22 years, 22 and a half approximately. So there's some method to this matter, and that bubble is bursting. The difference, Jason, is the government is extending this bubble and won't let it burst because they know Ben Bernanke started in 2008. He got so aggressive. He knows that when a bubble bursts, you get a depression, not a recession. And no politician, no Federal Reserve chairman wants to be in power
I agree.
when that happens.
I agree. And this, by the way, is one of the things I think a lot of the sort of Peter Schiff types miss. I mean, look, as much as we might philosophically disagree with it, I don't want to live in a centrally planned economy. I think the free market should run the economy. I don't really believe we should have a powerful central bank. I think it should be a minimalist central bank.
I agree.
But we have what we have. And the fact is, they don't want to see the economy crash either. So they're going to step in and do their thing, and that's what's going to happen. And a lot of economists just don't account for that. They just think that it's just math, that the market will just work on supply and demand and all that stuff, as it should. But that's not what we have. We have a centrally planned
economy. The market happily accepts all these new financial assets that have been created out of nothing, pouring more, all this money they poured in the economy. $27 trillion, by the way, I quoted that earlier, never happened before, 9% of GDP on average yearly. That money has gone into financial assets, has inflated this bubble. That's what's happened. So this bubble at some point has to burst. The trillion-dollar question that you keep asking is when. I think now, only because they went into such extremes in bailing out COVID that they created that 9% sudden inflation, and they had to tighten hard, and they did, and we have not felt that yet. We're going to feel that first quarter the most, the first quarter of next year. So about 6 months from now, that's when I'll be able to look at my newsletter subscribers and say, I think it's going to be much harder than people think by then, but here's how much the tightening hit, because they went straight from stimulus to tightening. That's never happened in history before either. So the stimulus, worn off and they're tightening so that, we're really going to get the truth in the next 6 months is what I'm telling investors. I just warn people, be safe here. Stocks may look like they're going to keep going up. They could go down anytime. The first crash out of every bubble in history has been 40%, typically in a matter of 6 months or less, okay? So this thing could happen so hard that by the time you realize it's a crash and not a correction, you're already too far into it. I say this good time to be out of stocks generally, out of real estate you don't really need, especially speculative real estate, and see if this thing sets in, because I think it's going to set in. I think 2025 is going to be the worst year we see in our lifetime.
Okay, so I just want to get clear. This chart on the Bitcoin, what's going to happen to the price of Bitcoin?
Bitcoin is what I call the lead dog. Okay. It is the lead dog of the crypto pack, and kind of like Amazon was the lead dog for the .com bubble, okay? So, and I compare Bitcoin, and like I said earlier, directly with Amazon. So I'm looking at the Bitcoin bubble hit 73, peaked there. It's been going sideways because no bubble and everything's saying the bubble's not going to burst. Nobody wants it to burst. It's been going sideways, but in a downward thing. It's been having lower highs and even lower lows. That's what this chart is. It's called a declining megaphone. Megaphone is when it goes like this, not a channel is straight, parallel, a triangle is converging. This is a megaphone pattern pointing downward. We're going to get resistance if Bitcoin keeps going up. It's at 65.5 today. It's going to get resistance at 68,000 if it even makes it there. The final wave up usually does not go all the way up because it would make it too obvious. And if it goes down, we could see a sharp move in a short period of time down to the bottom of this channel, megaphone, about 40 to 42,000. And if it breaks that, we're back to the 15,600 lows, okay, in Bitcoin back in 22 or whatever, the last.
Okay, major. So your prediction is Bitcoin is going to drop to 40,000.
And Bitcoin leads everything else. Crypto goes down. Stocks will follow that, and they have generally followed on 3 to. So
what's your S&P number?
Stocks peaked in July. That's a 4-month lag that stocks are following Bitcoin already.
Okay, so you think stocks are going down, and what's going to happen?
But I'm looking at Bitcoin because Bitcoin will tell you when to expect stocks to go down. It's very hard to predict this. Stocks don't want to go. Nothing wants to go down. Nobody wants this bubble to burst, let alone the government and the Federal Reserve, okay, as we've already discussed. So markets have to get bad enough on their own to start to trigger fear with investors, and then they start thinking differently. They start thinking, oh, they can crash, sort of thing. So you have to get some momentum. So if we're going to see this, Jason, Bitcoin's going to lead this trend, and that's why
we got it on the Bitcoin. Okay, so I got it. So S&P is just over 5,700 right now. Yeah. Where's that going?
Well, it's got to go down about 40% just to get back down to the late 22 lows.
Ouch! Oh my God!
Yeah, that's when you realize
that's going to be painful.
How big a bubble is. When I say, wait a minute, a 40% crash is just going back a year and a half. Yep. Whoa, that means you had a really big bubble to go that much to have to crash that much.
Okay,
so that's why I'm saying you got to be cautious here, because when this happens, it's going to come fast. The 22 crash came fast. This will come even faster than that. Okay.
So Bitcoin is going.
But if Bitcoin starts to go, that gives you a little warning for stocks. So if it starts to get more serious, again, you see this pattern playing out, then yes, then you can get more serious about selling your stocks and so on. So you don't have to leave the bubble too early.
All right. So what I'm saying is Bitcoin is going to go down by a little more than a third. That's your prediction, right?
That's over 40% just to drop to 40.
Oh, yeah. Sorry, 40%.
I think that's 46% just to get to the bottom line there.
Hang on, I just want to get clear on a couple things. So Bitcoin's going to go down by 46%. S&P is going to go down by about 40%. What about gold? What about precious metals?
Gold is in its final bubble. Gold last time bubbled up with everything else. All the gold bugs say, gold's going to be the savior in the downturn. No, gold ended up going down in 2008, not as much as stocks, but it went down in the end. And this time, gold has bubbled up way more. And so gold, I'm predicting gold will peak here around 2,800, wherever it does. And when things crash on a lag, gold will end up, its support is around 1,100. That's a big crashing. That's maybe a 50, 60% crash in gold. And people think gold is going to be the safe haven. It won't be the worst place to be, but I'm telling you, in 2008 proved this, in the end, it will not be the safe haven. Treasury bonds are the safest thing on earth, despite our massive deficits, because everybody has bigger deficits than we do, and we're still the lead dog.
And, we should really, it's fair to ask, what will the value of cash be? What will the value of treasuries be vis-a-vis inflation? You've been pretty much a deflation guy for quite a while.
Yeah. First of all, there's very little inflation now. In my scenario, inflation will be 0 to negative. It was 0.4% in the last crash, okay, in 2009. So inflation is not an issue. Treasury bonds are the safe haven. They went up 45% when gold and stocks and real estate and everything else went down, okay, and commodities and stuff. Treasury bonds were the one thing that went up 45% in 2008. And then it was time to sell them because that was just a safe haven play. Who wants a 2, 3, 4% yield long term? Okay.
Okay, but I just want to be clear. So Harry Dent is not worried about inflation.
No,
right?
I am not. They could blow $5 trillion in the economy, and you might get a quick blip like we got 9%. That 9% blow, that came with COVID, that would have been over in a year if they hadn't have done anything.
So in other words, you're saying it's going to be either flat or a little bit of deflation, right?
Yeah.
That's your prediction?
Yeah. Only two scenarios I have in a slowdown. We have to have a slowdown first. So that's the first thing I'm looking for. Bitcoin to start crashing, stocks to follow. Stocks going down alone will make people a little more bearish, and then the economy to start to slow. And then it all bubbles, once they don't have to get going too much. They're so overvalued, the momentum gets very fast.
Okay. Let's talk politics for a minute if we can. I'm sure you have some opinions on this crazy political environment we're in. What do you think? And does your strategy change depending on the election?
No, it really doesn't. Most people don't get to do even a fraction of what they said they're going to do because of the split Congress and it takes forever to pass. People acting like suddenly Kamala's going to get things and do all these things, or Trump is going to cut all this by 80%. Not going to happen. So no. And it never does. What I would be good, Jason, is talking to people like running for president and tell them when to run or not, okay? This isn't an election to win, especially not for the incumbent. In other words, Trump would do better in this scenario. If he wins and the economy crashes, as I'm saying, right as he's walking in office, there's no way you're going to blame somebody that just walked into office, okay? Franklin Delano Roosevelt didn't get blamed for the Great Depression. He walked in well into it. Ronald Reagan didn't get blamed for the early 80s recession. He walked into when it already just started in 1980, okay? So that's the person who gets favored. And then it only takes 2 to 3 years to turn around the worst downturn, i.e. the Great Depression. And so by the time re-election comes up, whoever does win this election, either one of them, will look good and probably get reelected, but particularly if it's a new guy, Trump, that comes in. Now, Trump cannot run again. Now, Kamala is kind of in the middle. She's not Joe Biden, but she was her vice president, so she's a little more attached to the incumbent. If suddenly she walks into office and the economy goes down, well, people will blame Biden, which means indirectly they'll blame her to some degree. The problem is he's not responsible for this, okay? This bubble, the Federal Reserve and central banks have cranked up this bubble around the world. And Biden didn't tell them that they like them to crank it up during their term, but they're not in control of that. But people will still blame. So I would not want to be elected if I'm Kamala or Joe Biden got pushed out, but he's going to thank God he got pushed out, okay? He's the guy that would have looked the worst if he'd have won. And then while he's getting increasingly senile, the economy gets senile faster than him.
Yeah, interesting. Harry, you've done some interesting research on things like solar cycles and stuff like that. I'm curious, what is that and how does it affect us?
Yeah, the sunspot cycles are like 11 years on average. They vary some, and sometimes get a little longer or not, and you can track that. They affect business activity more. When the sunspot cycles are high, you're more likely to get higher valuations. I'd say they affect to some degree, but they don't affect the economy like these. The two things I track: a 39-year approximate generation cycle, which I can measure exactly how many people are going to move into peak spending from a generation. And the technology cycle, you get two bubbles or booms and busts in a 45-year time frame, like the bubble into 2000 and the bubble into late 2021. Those were, 21 and a half years apart, right about that half of that 45-year cycle. So those are the two reliable cycles that I can predict and have the most direct impacts on the economy, way more. I look at any cycle, okay? And I like to study cycles in general, and I've studied more. So if I told people all the cycles I've studied, they'd think I was a nutcase, okay?
Yeah.
So I don't talk about all that. I don't want to confuse people. But I study other cycles because the more cycle you study, the more you get insights on what happens in each phase. Every cycle breaks into 4 seasons, just like our annual cycle and sort of stuff. So I have a whole wealth of knowledge on cycles, but these two cycles are the ones, and when you're in bubbles, the bubbles always come from the 45-year innovation technology cycle. That's what bubbles up. It's the tech stocks that lead bubbles, not the Johnson and Johnsons.
I'm curious though, how do sunspots influence the economy? Like, why would they do that? What causes that?
Oh, that is a layup. More energy is falling on everything from plants grow faster. People feel more energy. People go out on this beach to soak up what? Energy. They're sitting there doing nothing, relaxing, soaking up energy. So it is literally more energy or less energy falling on everything on Earth. So that's an easy one for me. And I say it's an indirect. Doesn't mean people go out, oh gosh, I'm hot, so I'll buy a popsicle, although that happens. But you know what I mean? But I can understand that. And it's not, this would be a bigger cycle I track. It's not anywhere near the impact of these other two cycles I'm talking.
Yeah, really very interesting. Harry, anything else you want to say as we wrap it up? Of course, give out your website where people can get your newsletter. Anything else you want to share?
Yeah. Here's the most important thing, and I hate to say this because the guy lives right down the road from me, here in Puerto Rico. A lot of financial newsletter people are here in Puerto Rico because it's a great place and low taxes. Inflation is not going to be the outcome of this. It's impossible. An asset bubble, when it deflates, it takes money. This is money that's been created. Money comes out of thin air already, but financial assets blow that even more. When financial assets deflate, again, biggest number in the world is 630 trillion in financial assets, 6 times the GDP. That's what's going to happen here. This is not a normal downturn where businesses overexpand and they lay off workers and that causes more layoffs because it's, It'll be that. This is a whole nother dimension. And that's what was different from the 30s depression and the 70s long recession. So that's what you got to think. What you got to worry most about, your job second, you got to worry about your financial assets, real estate and the stocks and things like that you own. Anything that's financially valued has been blown up to at least double its value. Stocks more so, and real estate has to correct. I used to say 50%. Real estate's gotten the point to just get back to where it was before the bubble started. And that's in 2012, Jace, okay? That's at the last correction in real estate. That's not that far back. Stocks have to go to 2009 to get back to fair value. Real estate just has to go back to 2012. So you look at I tell anybody in this audience, look at your real estate. If you can determine what it was worth, let's say in the middle of 2012, give or take, that's your potential downside. Are you comfortable with that? If it's 20%, most people be comfortable with that. I'm telling you, it's probably going to be 40, 50, 60, 70%.
Oh my gosh. Wow.
That's how
Harry,
much
I gotta ask you a question. Why does real estate have to go back to the 2012 price? Why?
If you study every bubble in history, and I actually, there's a chart in there, my thing, the first one, I think, South Seas bubble was the first one, okay? It was like one individual stock. There was a
John Law, I know.
It went up from 1 to 99 and all the way back to where the bubble started at 1. Bubbles erase themselves and then start going back up and normal. In other words, they race more than they should because just as they go up more than it's worth, they also end up going down more than they should. So that's why bubbles are so treacherous.
I don't know why.
2009 is where bubbles would have to go to raise themselves for stock. That's when it started. And I look at 2012 for where real estate would have to go to raise its bubble. And that's and it can be different in different areas, but that allows you to look at different real estate. Real estate's much more varied than stock. There's a lot of real estate that won't go down that much.
Yeah. But I just don't understand why you're saying it has to.
You're gonna have to ask God on that one, Jason. I'm sorry.
Well, no, I know.
This is the law of nature. Things go up, they go down. Everything is cycles. People say, Harry, why are there cycles? I don't know. Ask God. Everything goes in cycles. There's menstrual cycles, okay? There's cycles in everything. There's mice cycles.
But let me talk for a second.
Sunspot cycles. Why does sunspots have cycles? I don't know. They do.
Okay. So here's the thing I'm pointing out is that how much coffee do you drink, by the way?
Three Nespressos in the morning, and those aren't a full. Those are about a 6/10 of a cup. So
wow, that's not much. Okay, you just have naturally a lot of.
Oh no, no, I don't need coffee. You get me on a stage, and
I know I've seen you on stages many times. Okay, but here's the thing, essentially you're saying, I mean, look, I don't know about the stocks. I'm not that versed in it, but the real estate I know, right? It's like looking at a chart. It has to go back to the trend line, the support level, which you're saying is 2012. Okay.
2012 for real estate.
Yeah. I know. But that doesn't take into account changing demographics, housing inventory.
Jason, all I do is look at history, and every bubble's the same, no matter where it came, no matter. I know what you're saying. People always say, yeah, but you know how many people coming after every president, but Harry, my place, if you saw it, it's so special.
No, it's not about, I agree with you on that.
You know what goes down the most, Jason? The special real estate goes down the most. Why? Because it's so special, it bubbles the most.
I hate when people
all I
do
care
that.
is bubble up, bubble burst. I could look at any bubble and tell you where I think it's going and not have any idea what it was. It could be mice droppings. Okay. And if I see a bubble, I'll say, okay, well, this is probably going to go back to about here. I'm so sorry. I can do that.
Yeah. Oh,
bubbles are bubbles.
Yeah, right. Okay. It doesn't take into account changing population, changing
everything.
demographics.
You don't have bubbles in places that aren't growing already. You don't have bubbles in depressed places. You have bubbles in the new technologies are where the bubbles are. This is the new high growth stuff. So bubbles aren't random either. They come where there's very high growth, and human nature is to overreact to everything. We oversteer, overdo everything. Things get good long enough, we get overly positive about everything. Things go down long enough. People say life will never be the same. We'll never come back. Blah, blah, blah. My kids will never, get good. People overreact. That's what we do. We just overreaction machine.
You talked about technology several times. Just before you go, I want to ask you some of these. Like, is AI a bubble? That's the big thing right now.
This is everybody's talking about AI. Early stage bubble. The crypto bubble is a bigger one. Crypto bubble, literally, when a speaker got up at my own conference and said it's about the digitization of all financial assets in the world, I'm like, I get it now. That's huge. 630 trillion. Even if you just 10% of that is huge if you can improve it. So that's when I got that this is a big thing. So AI is also a big thing, but Jason, I was talking about this in my Roaring 2000s book in 1998. I called it the automation of management and professional work. We automated farm work and then factory work. And then we've automated everything in the office, bookkeeping and all this stuff, automated computers, simple left brain stuff. Now we automate professional and manager. 80% of what lawyers and doctors and all these people and high-level managers do is automatable too, okay? Anything left brain is just more complex, but anything left brain. So now we automate that, and that brings a whole nother revolution because that's where the highest costs are. And the people, and more of us are getting higher education and becoming these professional and managerial people now that we've automated everything else. So we're always automating the present jobs, and that opens up people to move into new, higher human creative. We're going to have to do more and more creative right brain work because computers are left brain machines. Mm-hmm. Anything left brain can eventually put in a computer and be done at a fraction of a cost at the speed of light. Yeah. That's what you're competing with, anything left brain.
Pretty amazing, no question about it. Harry, where do people find you and get your newsletter?
Okay, harrydent.com. That's simple. That site, we have hsdent.com to learn more about us, but you go to that site, that's how you just get on our free newsletter. All you do is push a button, put in your email, you're done, okay? And that, right now, I should be listened to just as an alternative voice here, because anybody'd have to agree, this is not normal times. This is the greatest expansion, the most global, the most volatile things happening. You need to listen to alternative voices here.
Yeah, no,
listen to me for free.
I get it.
One article a week and two rants. I'm going to talk to you twice a month for 5 to 10 minutes.
Yeah, you're definitely a ranter. I watch your rants. They're great. But, the thing is, the thing people never realize is, yes, you can say everything's a bubble, everything's overexpanded, et cetera, but the question nobody knows the answer to is how much longer can they keep kicking this can down the road?
Well, I tell you, Jason, the answer to me was a lot
Maybe they can print another 50 trillion and it won't even matter.
The answer was, for me, for a long time, a lot longer than I thought, but they did raise interest rates 525 basis points, and they cut that 9 trillion bloated balance sheet, 2 trillion almost, okay? That is big tightening. And that will take a year and a half to hit by past analysis. And that's why I'm not going to judge how much it's going to impact fully until the end of the first quarter of next year. And then I'll say, okay, now we know what we're dealing with. And I am expecting the economy to be significantly weaker by then. Stock market's always ahead of that. Bitcoin tends to be ahead of that. Why I'm looking at Bitcoin now and Bitcoin peaking and dropping. So I want to be ahead of it, and I want my subscribers to be ahead of it. It's that simple.
And the way to get ahead of it is buy Treasury bills. Buy T-bills.
I don't want Treasury bills. I want Treasury bonds, the longest duration, which is 30 years. Okay. Now, so if you're buying a Treasury bond,
buy 30-year Treasury bonds. That's Harry's advice.
30-year, because the longer the duration, the more the deflationary multiplier is going to happen for you. I'm saying that a 30-year bond will more than double if I'm right about this downturn being 50% deeper than the last one.
And one of the reasons you're saying that is because we're going to have flat inflation or actual deflation, which makes the value of the bond
and when you locked in a 4% return for 30 years when it should be 1% over deflation or zero, how much is that bond worth?
Yeah. Okay.
Normally it would be impossible for a safe Treasury bond to double. We already saw the 10-year bond go up 45%, not the 30. That was probably 65, 70. 10-year bond went up 45% in the 2008 crash in less than a year. That's what I'm looking at. This is your safe haven. Peter Schiff's going to tell you to go under. He's going to be right about this crash. He's going to be wrong about it sparking hyperinflation. It's only going to deflate when these financial assets do that. Nobody could print enough money to beat the financial deflation crash. I'm just telling you, almost impossible, or you'd look like an idiot and be shot, okay? So that means that the Treasury
I think they would have easily said that before the COVID era, and they just printed like crazy. But yeah.
The crash that deflated the last big bubble in history was 29 to 32, and that caused the deepest deflation and deepest unemployment and the biggest stock crash in all of modern history. And this one should be worse, if anything.
Wow.
The size of the bubble.
Yeah. Okay, folks, get your bunker ready. You better be prepared for this one.
I'm in Puerto Rico, man. We're not even going to catch this in the breeze. I'm telling you, we're a quarter of the way. People think we're south of Florida. We're a quarter of the way to Africa.
Yeah. Wow. Crazy. Okay. Well, Harry Dent, thank you for joining us. Everybody, you know where to get the newsletter, HS Dent or HarryDent.com.
HarryDent.com.
Yeah. Good stuff. Harry Dent, thanks again.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.